When rapid speed down to 2,500.
Good point. Wherever you reduce speed to 180.
BlackBox. Hey gang, Kenny Porter here, KP's BlackBox. Welcome back. Today we have a special guest with us. I'm going to give you a little introduction here in just a few minutes to my new friend George. But thank you for showing up today. And I think this is going to be a very insightful podcast that I've been waiting to do for a couple years now, and have found an expert to talk about a topic today that I think is important for pre-retirees, retirees, and anybody thinking about retirement. This is an education that you do not want to miss, so pay attention. And as always, thanks for showing up. And to get the crazy stuff out of the way, hit the subscribe button, smash the like button, and give us some comments below. Let us know what you think about today's podcast. And don't pick on George too much about being a UCF grad. I just found out off camera he was a soccer player there. Or football.
Yeah.
Football. But today's topic is probably going to be one of the most controversial financial podcasts that I've done. We're not going to talk about cryptocurrency. We're not going to talk about annuities, life insurance. I would say, George, those are probably in the top 5 of when you bring up those products to your financial clients. They're like, okay, what are you selling me?
And used cars.
Yes. So right up there in those topics is a controversial product, but a very, very important product to understand how it works in your overall financial process is actually a reverse mortgage. I said it. Yes, a reverse mortgage. So today we have George Vrban of Movement Mortgage. He's down in Florida. I couldn't talk him into leaving the beautiful Sunshine State to come up to Virginia Beach and do it in the studio. So as you can see here, I got George on the big screen, and I got to get used to talking to the little camera here versus talking to George across the table from me. But George Vrban, thank you, sir, for joining us today.
Thank you. Thanks for having me.
You're so welcome. We're excited to have this conversation with you. Starting out, one of the things that we like to do, George, and I was sharing with you earlier, that yesterday was the 80th anniversary of D-Day and storming the beaches of Normandy. And one of the things we like to do on KP's BlackBox is honor those who have served and those who have made the ultimate sacrifice, like those young men, 17, 18, 19-year-old men who stormed the beaches of Normandy in the name of freedom for the world, not just the U.S. And we like to give a little toast to those who have served and those who have made the ultimate sacrifice. And then to your point, George, you've got, I think you said, an aunt who serves as a Navy chief, U.S. Navy. Is that right?
I have a cousin that
Cousin.
is served about 22, 23 years and retired as a U.S. Navy chief. And,
Excellent.
It's a salute to them, but also to the families that have done everything, support the people that have helped us keep this country safe, right?
What's your cousin's name?
Heather.
Heather. So let's
Heather
do a little salute to Heather and all the
Cheers.
sailors, Marines, airmen, puddle jumpers, coasties, and Army. Cheers to you guys. Thank you for your service.
Cheers. I got to tell you a funny story about Marines.
Oh boy.
Here we go. I have a big respect for Marines more than anybody. I have no offense to the other forces, but
well, that's the reason we have other branches. Not everybody could be a Marine, George. So,
right, that's right. But they serve that front line. I tell you, But I was at 10 years old in Cleveland, Ohio. That's where I'm from.
Awesome.
And I was actually in the mini. They called it a mini Marine Corps branch, basically at a 10-year-old.
Wow. Okay.
And I had a drill sergeant that had one eyebrow. They just went across, across his.
That's a real unibrow, right?
Yes, it was, and very intimidating. And he said, "This is my experience in the military, by the way." So he goes, "George, I need you to run the platoon." And I'm sitting there looking back at all my 10-year-old buddies, 10-year-olds, looking back, and I'm like, and we actually went to amusement park, and we ended up. He says, "Okay, you got to get your group back here at 1 o'clock." And I'm sitting there going, "How am I going to get this group back at 1 o'clock?" Well,
As a 10-year-old.
sure enough, I could not lasso everybody and get it back exactly at 1 o'clock, and
or 1300, as the Marines would say.
1300 is
right?
what they said, right?
Yeah.
So 1300 hour, and I get back, and he goes, "Where's your rest of your platoon?" And he started yelling at me, and I'm 10 years old. And I said to my parents, I said, "You know what? I quit." I said, that was my extent of it. I didn't have the, what, to hang in there at 10 years old. So I said, "Man, I don't think I'm going to make it as a military guy for myself." But yeah, that was my experience with the Marines.
That's a lot of pressure to put on a 10-year-old for.
It is. That's what I thought too. So
herding cats at any age, especially at 10.
Yes, especially, yeah.
Corralling those in.
Yes,
so he broke you from wanting to be a Marine, huh? Wow.
He did. I still have a respect for him now.
Yeah. Can you imagine, George? I mean, I know in the space that you and I deal in, you as a reverse mortgage specialist and me in a financial planning capacity in my real business, my real firm, that think back to when you were 17, 18, 19 years old. And can you imagine that you get the call one day that says, "Hey, George, we need you to go serve your country in a way that, we got to go serve your country in a way that you have to protect freedom for all. And we got to put you on this bus. We're going to send you down to Paris Island, put you through 13 weeks of boot camp. And then immediately, with that little bit of training, we're going to have you attack the shores of a place called Omaha Beach and various places throughout France, England, Normandy, hitting those beaches at 17, 18, 19 years old, airmen and Army paratroopers, deploying out of an airplane at that young age. And man, I can't imagine, like, I've got 3 boys. I can imagine, and 2 of my boys have served in the military. Jacob here serves in our church, and all are noble callings, right? But to be a father who would have to hug your boys and send them away to war on the other side of the planet to squash tyranny and to squash the oppression that was happening in Nazi Germany during that time. And then over in the Pacific, with Imperial Japan at the time. Can you imagine? 17, 18, 19 years old, being gone for your family for not a 6-month deployment, not a 9-month deployment, but many of these guys were gone for 2, 3, 4 years before they saw their family. So the greatest generation. What's your thoughts on that?
Well, yeah, I mean, that's, but what's interesting back then, I can, when you said that, I was kind of going back then. There was just something, maybe it's different. Maybe the audience might correct me on this part, but I don't know what it was, but I just felt like back then, people were just ready to jump up and figure out what to do for their country. And at that point back then, even the parents would understand, do what you got to do, right. Have that support.
Yeah.
Today, I don't know if that's the case. I just, back then there was such a undying resolve to help solve all these problems, right?
Yeah.
I don't know, correct me if I'm wrong. Maybe it's just different today compared to what it was back then, but back then there was just this unresolved to do whatever it takes to help this country and help the world. And maybe it's different today. I don't know, but maybe I'm wrong, but I don't know. But it just seemed that intensity back then was there.
But The piece that I would add to that, and I don't disagree with the word you said, the piece that I would add to it is I think what we've seen in our society over the last 80 years, since D-Day, is that the sacrifice that our grandfathers and great-grandfathers made, and grandmothers, for that matter, and family members, that sacrifice is those folks did hard things. They faced hard things so that the future generations could have it easier. And George, my personal opinion, it doesn't have anything to do with politics, but it has everything to do with the creature comforts of life that we have today and that we appreciate today in the United States is built on the back of those who just, to your point, just went and did it. They didn't complain, and if they did, there was a lot of it they kept to themselves.
They did. That's true.
And they made the ultimate sacrifice for us to have it easier. And I think what we've faced today and what we're facing today in our society is that we're kind of soft, right? And this isn't like a tough guy, vibrato, you got to be tough to make, but doing hard things matters. And the harder something is, the more you appreciate it, is what I have found to be true.
Yeah.
And it doesn't mean that we need to make things hard or make things complicated. It's just, hey, do you have the resolve? I had a Marine gunny say to me, and we can get into the podcast after this, the real topic, but just again, honoring these folks who have served us. It's deep on my heart today, being, 80 years and a day since we stormed the beaches of Normandy. And I've got a buddy who actually jumped over Normandy this week.
Really?
Yeah, I don't want to get into too much of the detail and take away from today. It's a totally different podcast, but yeah, he and a few other warriors who served during GWAT, the Global War on Terrorism, was called to go jump with a group of men over the shores of Normandy, which is awesome. And I can't wait to see the raw footage that he'll bring back from that. I've seen little bits and pieces of it out on Instagram. But he got this week to hang out with a few of those veterans. And when you think about the people that have enlisted during that time, George, the number I think right now is there's about 119,000 veterans from that era still living today. And they're quickly aging out. Most of them, the average age, I think, is 80, like late 80s, early 90s. Some have already reached 100 years old plus. And it was just really an honor for him to be able to go and jump on those beaches that young 17, 18, 19-year-old men did during that period. And so just super awesome. I'm just little
You're proud.
Just very, very proud of those who served. And so trying to segue into reverse mortgages now is going to be tough. But
as we age in place.
Yeah, that's right.
Age.
So thanks again to all you who have served and the family members who are still serving. That's a long toast, but we got through it.
Amen.
So George, you've been in the financial business for how long? Tell me a little bit about your career and what brings you to this stage today of reverse mortgages.
Well, I guess I'm probably one of the more seasoned vets out there today. Believe it or not, I've been in the reverse mortgage space for 20 years, close to 20 years.
Wow. Okay.
And, but I literally work with over 800 financial planners in 27 states, teaching cash flow tax strategies. Unfortunately, this product is not being taught necessarily as a retirement strategy.
Right. I agree.
My goal is to work right alongside the financial planner. I'm trying to show people at 62 and above that there are other tools out there today that can literally help improve the probability of their money lasting longer in retirement. Because the one dynamic that's changed today is people are living longer.
Yeah.
And they're living into their 80s and 90s, like you just mentioned about the vets.
Yep.
And people are just simply running out of cash, or they stop working a little too soon, or they just thought their money was just going to last a lot longer. And I've been doing this stuff and I love teaching and I love educating. That's what I like to do more than anything, is just making sure people truly understand how this product works and how is it truly implemented as part of that retirement strategies. So
So
that's what I
George,
like to do.
let's get the big gorilla out of the room, if we can. Um, I've heard this before. Reverse mortgages are only for destitute or poor people. What's your answer to
Yeah,
that?
well, I mean, first of all, I don't want to dismiss people that are in dire need of needing some help. I help
Okay.
out whoever I can help out, right? It doesn't matter if they're limited on the resources. But what's interesting in my clientele, um, my average net worth clients go up to $5 million. I do reverse mortgages for,
Wow.
and people will call me up and they go, George, why in the world would somebody with $5 million want to do a reverse mortgage? And I say, because they don't want to donate to the government. Once they understand the concept, they're going to figure out creative ways to keep more of their money and pass it on to their family, right? Which
Right.
is part of that legacy that we're trying to help out. So yeah,
And there's a
it's
big portion, George. What I've found to be true is there's a large number of folks who believe that paying off their house and leaving the house to their kids is the only way to do what you just said. But there are some alternative methods and methodology that, from an actuarial science point of view, could make a whole lot more sense. And so that's really what I want to dig into today, and learn from you, and our audience learn from you. So, you know, the 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 bad press that reverse mortgages got. You were around, so 20 years. You were around during the bad press days.
Mhm.
What created the bad press? What happened in the early days of reverse mortgages that they got a bad name?
Well, first of all, as a matter of fact, Isaiah and I were just talking about that. I felt back in the day what happened was the program did need to have some improvements done on it, right? Ronald Reagan actually started making some changes back in the 1980s on this particular program because he saw that there was a need to help out people in retirement in this particular product. But the vast amount of improvements really hasn't happened since probably the last 10 years.
Yeah.
And so it's actually probably the safest loan you're going to find out there in America today. But one of the reasons that what caused a lot of that stigma was people were going into impoverished areas doing a reverse mortgage on areas where people had free houses that were free and clear. Well, a lot of them didn't pay homeowners insurance because they didn't need to have homeowners insurance if they had a free and clear home. And there's only three rules. You got to pay your taxes, property taxes, your homeowners insurance, and upkeep of the house, right?
Right.
So people would take this money, they would blow through their cash, but they didn't follow the rules. And what happened was they would maybe pay their taxes, but they didn't pay their homeowner insurance because they're never used to probably having it. And then the bank will start the foreclosure process because if you don't follow the rules, this is what happens. And what happened was when you would read stories like that in the paper, people would, if you dig down deep and you find out what the scoop was, they blamed it on a reverse mortgage.
Yeah. On the lender.
They never blamed. Yeah, on the lender.
Yeah.
And I'm sitting there like, wait a minute, you got to pay your taxes and insurance. That was from the very beginning. So there are so many protections today and so many things in place today to help people make sure they understand you've got to take care of these, two important things, taxes and insurance, and nobody can mess with you. It's just, you got to do that on any mortgage, not
Right.
just a reverse.
Right.
But we got stuck with that stigma on the industry back in the day. And that's usually what happened. People in my industry, unfortunately, in my space, went to these impoverished areas to basically give them all this money on a reverse mortgage on a heck 'em.
Yeah.
And unfortunately, people blew through their cash or they just didn't follow the rules. And that's what happened back in the day in particular. But, going back to your other point, so you brought up an interesting point. I get a lot of people that ask me that too. They go, George, I want to leave the house to the kids. Here's what I run into in 20 years I've been doing this. You know where that came from, by the way? First of all, we've been brought up, this generation, right? I'm in my 60s. So we've been brought up fixed rate loan, pay off the loan, mortgage burning party, give the house to the kids.
Right.
That's what what we were exposed to. But you know where that came from? It came from people in the 60s, because what happened was the parents weren't living past their 60s. The average death back in the 50s and 60s, people were not making past the 60s. So guess what? They would literally pass the house on to the kids, and the kids would take it because they're in their 20s and 30s.
Yeah.
And here's the dynamic that's changed. And I asked the parents today, and I go, people are living into their 80s and 90s. Now, when the parents ask their kids when they're in their 50s and 60s, do you want the house? Guess how many kids really want their parents' house?
They want the cash.
Exactly. They can care less about the house.
Right.
So why are we like a hamster in a wheel trying to pay off a house and give them something they don't really want?
Right.
It's just, but there's other ways to leave a legacy behind for the kids.
Yeah.
It's not the house. They can care less about your house. But that's where I work with financial planners, because I show other creative ways to leave a legacy. But this is the stuff that I run into all over. It's just a matter of educating. But when I ask that question, you'd be shocked. People are like, I guess not. I guess they only want the house. I go, yeah, that's usually the case. But I did that too in the last 2 weeks.
Well, you make a great point that when you go back and look at the early days of Social Security, when Social Security was first opened up to where males and females, not just a benefit for widows and orphans, the average male in the United States had a life expectancy around 65. And so there was no mistake that actuarially, the pension actuaries for the trust benefit plan of social insurance set these guidelines to where the recipients would not receive a benefit for many years. That many years, I should say, in terms of life expectancy. And then wouldn't you know it, we threw a curveball at the government, and through medical science and through the advent of new medications and learning more about the human body, life expectancy in the U.S. went up to right now, a male has a life expectancy. A standard male has a life expectancy of about 84 years. A female has a life expectancy of about 87 years. But when you think about averages, George, and I know you know these numbers already, but in averages, 50% are going to make it past that number. 50% are going to make it short of average.
Yep.
And what the Social Security Administration says today, and the Bureau of Economic Analysis up in D.C., is that they say that if two people make it into their 60s together, there's about a 25% chance that spousal unit is going to make it into their early 90s. So say around 93. And then there's a 50% chance that one of those people make it into their late 90s. And when I think about going back to the shout out to all of our veterans, here we are in 2024, and we have 119 plus thousand, I think it was 100 and some thousand veterans who are still able to tell the story about Normandy. So when you look at that and you look at our society as an aging society, I think we're the third or fourth oldest society in the world right now. I think Japan's number one. To your point earlier on, one of the big reasons that I want to look at this for my clients is to make the assets last longer, not just the mortgage asset, not just the real estate, but their overall assets, their entire wealth. And so can we start peeling this onion back then that, 20 years ago when you entered this space, is it fair to say that it was kind of the Wild West? There wasn't a lot of regulatory guidelines around what a lender or product maker could do?
Yeah, there's some. I mean, it's just that it definitely needed some tweaking over the years. But I think I think you just hit on a very important part, right? So one of the greatest challenges we have today, right, and biggest fears in retirement is running out of money.
Right, correct.
But what's interesting is there's 5 different ways that affect running out of money.
Okay.
Longevity risk, which is what you just covered.
Right.
Inflation risk.
Correct.
Volatility.
Bingo.
Survivorship risk, which is what you talked about.
Yeah.
And tax risk, right? I mean, in today's challenging environment, it requires the financial professional to utilize and leverage all the family assets and resources effectively, right? That's why I give kudos to you. And in this industry, this financial planning industry, I just think it's been more embracing today than it was back in the day because of all the improvements that were done on the loan, for the better. But it's still the most glaring oversight or blind spot is utilizing housing wealth as part of that strategy process. For most clients, it's their single largest asset is their home. But there are still advisors that still ignore housing wealth as part of that contributing asset class and retirement income planning process. But that's the reason why I give credit to you and to the different financial planners I work with, because it's not just movement mortgage propaganda. These are people in your industry, in your space. Dr. Wade Fowle, Dr. Barry Sachs, John Salter, I can go on and on. Jamie Hopkins, I know Jamie. I know all these guys.
Yeah, I know Jamie. Shout out to Jamie.
Yeah, and Jamie's the one that actually came up with that article, right? He says, look, you guys got to incorporate this as part of their strategy today. It's not what people think it is. But what's interesting is it's not me saying, this is not propaganda for mortgage. This is all the latest empirical studies. Basically, when you use housing wealth as part of that retirement strategy, it can literally help clients improve household cash flow, create buffer accounts to mitigate sequence returns risk, which is what I do a lot of these, by the way, for lower tax liabilities, improve monthly cash liquidity, increase the net worth and legacy, passed on to the heirs, because the math, believe it or not, the math actually is there.
Right.
I'm a math guy. So I love to show. I have my own financial planning software that I show clients too. What does it look like 5 years from now? What does it look like 10 years from now?
Awesome.
I do. Yeah. So that's how I kind of team up, with people like yourself to do a discovery session, figure out what are we trying to solve for and how do we make that money go as far as we can.
That's excellent. So you're going to share with us some of that math today, right? You're going to show us some numbers?
I wasn't going to go in great detail, but I'll do enough just to go ahead and talk more about, about the product.
So let's get the regulatory stuff out of the way. A lot of folks today, they go on the internet, they do a search. But when we come down to how these products are regulated today, does it fall under FHA?
Yes. Mm-hmm.
Okay. So explain that to our listeners, if you would.
Well, it's just so this is kind of one of the things that I explain to clients all the time. I said, they come up to me and they ask me, they say, George, does the bank take my house? Does the government take my house? Do I lose title to the house? The answer is no. This is called the home equity conversion mortgage. It's nothing more than a home equity line. That's all it is. Right. Can you make a payment on a reverse mortgage? Yeah, you can make a payment if you have a burning desire to make a payment to an illiquid asset, you can. There's nothing wrong with that. But when can it be paid back? Well, you can wait till you sell the house. You can wait till you pass away. There's no urgency because there's no penalties on these things.
Okay.
So what the families do, though, with the house is a family decision when that time comes. It's not the bank or the government. The government only insures the loan. All they're doing is putting all these protections in place to make sure people don't get taken advantage of. And they have to follow simply 3 rules: pay your property taxes and homeowners insurance and upkeep. Because of these rules and because of some guarantees in here is one of the reasons why the banks are lending money today to get paid at a later date. They're not looking for their money today. They're looking for the money down the road.
So, right? George, let me take you back to those 3 guidelines. And I want to ask a question because it just kind of dawned on me now. So there's 3 rules that I keep hearing you say that a borrower of a reverse mortgage has to follow. Pay your property tax, pay your homeowner's insurance, and provide upkeep to your home. Number 3, that sounds a little subjective. So upkeep on the home, what does that mean? What does that look like?
That's a great question, actually, because, it's just out of habit, but there is no reverse mortgage police.
Okay.
In other words, they're not going to come out and check and see if your paint's peeling or anything. So it's not to that extreme at all. All they're doing is they're basically saying is, look, once a year, you're going to get what they call an occupancy affidavit. They're just making sure people are still living in the house. And if you don't respond to this affidavit, they will send somebody out just to see if somebody is living in the house. But where the upkeep of the house comes into play is tied to the homeowner's insurance.
Okay.
Because if you don't upkeep your house, they drop your homeowner's insurance. You're not going to be able to. You got to do
Yeah.
something, or
Yeah.
they're going to do something with they're going to ask you to do something with that loan.
Yeah.
So that's really tied more to the
Okay.
homeowners insurance.
Good to know.
More than, yeah.
Good to know. And I honestly, that wasn't a bait and switch question for the audience. I really didn't know the answer to that, but you kept saying it. And I was like, well, wait a minute. I don't think I've ever asked this question.
No,
So.
yeah, it's just, to me, it's because the people I get concerned for my clients when they, people are used to having a free and clear home, so they're not required to have a homeowner's insurance policy.
Which blows me
So,
away.
yeah,
A horror story that I remember watching a ABC interview. This has probably been, it was during the housing mortgage crisis, 2008-ish. And I remember there was these massive landslides that were taking place in western part of the country, in California specifically. And this guy was just out front of his home, and I want to say it was somewhere over towards Malibu, if I remember right. But he's in this interview with the ABC anchor, and the guy's just in tears. And the reporter's like, well, you just lost your home. Your land just slid off into the Pacific along with your house. And he said, the problem is that I lost my house. I can replace the house. However, it's going to cost me most of my retirement dollars because I just paid off my home and then canceled my my earthquake insurance. So one of the things, just like with a reverse mortgage, having that asset in place, that asset protector, we're big fans of protecting the financial castle. And one of those is that gets overlooked. A lot of people, when they go to pay off their house, and I have some clients with paid off homes right now, and like, well, Kenny, should I get rid of my homeowner's insurance? I go, well, if you want to take on 100% of the risk for your house burning down or a hurricane wiping it out here on the East Coast or on the West Coast, a landslide, excuse me, or earthquake, and you want to retain that responsibility and have no floor underneath your protection component, so to speak, of your property, then okay, drop your homeowner's insurance. However, what happens when that day comes, if it comes to you and the property goes away? Now you've got to write the big check to put your sticks and bricks back on the property. So, I think the requirement of pay your homeowner's insurance, that in and of itself, the old Murphy's Law, you cancel the homeowner's insurance, sure enough, something bad's going to happen.
Yeah.
So if you want things
Yeah.
to stay away, insure it.
Yeah. Now, insurance is a whole nother subject. I can do a
Yeah.
whole podcast on homeowners insurance because of what's changing out there today in the environment with roofs today. Used to be 30-year lifespan. They wouldn't look at changing homeowners insurance until 20 years into the lifespan.
Right.
Now they're trying to do it at 10 and 15. I'm like, this is crazy. Right.
Yeah.
So that's another whole subject matter, but
especially for Floridians, right? I mean, down there in Europe.
Yeah, I deal with that exactly. I've been dealing with this the whole time, so it's a little bit nutso. But it's interesting. You were talking about asset protection, right? So let me give you a real life story. I have a lot of examples.
Stories are great.
Yeah. So I have a client who had a $1.2 million house, free and clear. And once I educate, so when people get a chance to spend time with me, I will eliminate 95% of all these misconceptions and probably answer the majority of their questions to where they're probably going to have only one or two by the time I get done with them. But once they understand the product with me, then I implement the strategies, right? Once they get it, once they understand how it really works. So I did this with a financial planner. He called me up. He says, George, my client's taking out 25 grand a year from his IRA. He's going to bleed through that thing in no time. He's adamant. He needs that money. He wants that money. He wants to enjoy his retirement, but it's going to run out in a very short period of time. Can you explain this concept to him? So I literally showed him. Here's what's fascinating about the line of credit people didn't know. I showed him a strategy. I pulled out 25. Now, I want you to think about this because house is free and clear. Everything is based on the age of the youngest of the two borrowers and the appraised value, not the equity position. It's
Got it.
value, age, right? So if the house is $1 million, let's say I gave him 350 grand of a line of credit, free and clear. It's a free and clear home,
Okay.
no mortgage to pay. So you got $350,000. Okay, there's a guaranteed growth component. The interest rate's not guaranteed, but the growth is guaranteed. But I want you to think about this. He took out a 350 line of credit with me. I gave him 25 grand at closing, and then we came up with a strategy to pull out 25,000 a year for the next 10 years. So total, we pulled out 275. The line of credit started at 350. So how much do you think would be left after pulling out 275 from that 350?
You'd think there'd be another 75 left.
Yeah, that's what you would think, right?
Yeah.
Well, believe it or not, you know what the line of credit was 10 years later still? It was still $350,000 10 years later. It was still that much available in the line of credit.
And in excess of the 275 he had taken out.
Correct.
So you're talking about 625,000 of total
that he
equity.
Could technically pull out, right?
Wow.
Now, here's the kicker to this. It's tax-free. None of this is taxable income because it's borrowed money.
Borrowed money.
Right?
Yeah.
Right. So what did I do in that equation? Well, first of all, I provided a solution to fund his retirement by creating another $2,000 plus a month to supplement his income in retirement and enjoy his retirement. But here's the key. What did I help do to that IRA?
Extended the life of that investment.
Bingo.
Yeah.
Right. I made the cash, the physical cash, go further into retirement because when he was pulling it out, he was also getting taxed on it.
Yeah.
Right. So I literally pushed that IRA out as far as I could for them now.
So
now
George, if he needed 25 on top of his other assets and income, maybe he's drawing Social Security, maybe he's got a pension. I don't know the whole story of this guy, but in order to get 25, he probably had to draw out 32, let's say, to net
Correct.
25.
IRA, right? Exactly. You got it. Yeah. And so in this case, it's dollar for dollar. If you need 25, we just pull out 25,000 on the line of credit from the reverse.
Right.
And here's the other piece. I have my own financial planning software. So when I show 10 years later, he had a massive amount of equity. People just think that because of the interest rate and the costs and what's associated with this loan, that there's nothing left equity position wise down the road. And it's not accurate today. Why? Here's what's happened in the last 4 years. The rates have gone up. So the percentage we're loaning today is so much lower today.
Yeah.
But it's still enough to help people solve a lot of issues. And they still have tons of equity that's going to be left behind when that time comes. I literally give 10-year snapshots, and it's not what people think it is out there. It doesn't matter the interest. And I'm like, financial planners drill me all the time. They're like, George, give me worst case scenario. I'm always giving worst case scenario. I'm aggressive on the rate side. I'm conservative on the property appreciation of the house value. The arbitrage, what people are missing the boat on, the arbitrage is the value of the home going up. If the property values go up, even only at 2%, like a lot of the country's 4 to 10%, I only use 2%. I literally can show with the math.
So when you're talking arbitrage, for people who don't understand that term, you're talking about the delta between the cost of money,
correct,
and the appreciation of the property.
Correct.
And then the other side of that is the arbitrage between the tax-free cash flow versus the taxable amount that you have to take to equalize the tax-free cash flow.
Exactly.
Okay.
Yeah. And here's and another piece to that too is so people always come up to me and go, George, let me get this straight. I don't have to make a payment. I go, no, you can, but you don't have to. It's an optional payment program, right? So, well, doesn't the interest and all the costs, doesn't it eat into the equity of my property?
It continues to accumulate, George. Yeah.
Right. So people sit there and ask me that question all the time. And I'm like, yes, but you're forgetting the other half of the equation. And he goes, well, what's that? I said, you pull the money out. So what did you gain?
Right.
You gain cash. You can't ignore the other half of this equation. People are so caught up on equity. Yeah. You can lose 10, 20% of your equity next month if the market goes the other way.
The old saying is confusing the forest for the trees, right?
That's it. But, this is but when again, so it's not just me, explaining this. I want to show the math. So I'm always about trying to show them what it looks like 5 to 10 years, assuming you even pull out money. You give me the scenarios. How much you want to pull out now? What do you have to do? You have projects? Great. Give me a number. I'll plug it in and I'll show you what it looks like.
Well, George, here's another microeconomic component that people get fixated on. George, I heard these reverse mortgages are so expensive. I've got to pay all of these closing costs in order to put this loan in place.
So,
can we be micro
exactly
for a minute? Okay.
Yeah. No, I get excited about those because that's what I cover in the education piece. So this is again another misnomer. Are the costs more than normal on a reverse mortgage? The answer is yes. Why? Because that extra 2% is going to the government to insure the loan, right? There's a funding fee that gets rolled into the loan. What are the physical costs? There's only two. Counseling session runs about $155 and the appraisal fee. Everything else is rolled into the loan and we're using equity to fund all these different costs, right?
All right, so let me back you up. I hate to keep interrupting you.
Sure.
But let's peel this onion back. So 2% goes to the federal government to insure. What are they insuring?
Well, that's exactly what I was going to share with you. So I'm going to give you a worst case scenario. First of all, the closing cost varies state to state. It runs anywhere between 4 to 5%. Okay. Of that 4 to 5%, 2% goes to FHA.
4 to 5% of what?
Of the appraised value, not the loan amount.
Okay.
Yeah. So it's definitely, that's why it's more. That's why people are seeing this high number of the closing costs, right?
Wow.
So here's what I show the math. And I'd show them, I say, well, first of all, let's do a worst case scenario. Let's say a house is worth $200,000 and you borrowed 70 grand and that was the only amount you got. And you spent every penny of it. And you never paid it back. You're like, who cares? I get to stay in the house for the rest of my life. I'm good to go. But interest grew on the loan from 70 grand all the way to 200 grand 20 years later. But then the market crashed when they both died. The house is only worth 150. So they're upside down 50 grand. So the parents are going, or the kids are going, thanks a lot, mom and dad. House is only worth 150. You owe 200. It's upside down 50 grand. Who writes the check to the bank for that upside down 50 grand? Is it the kids or do they come after the assets? Are they going to call Kenny and say, Kenny, we need 50 grand?
Yep. We need to take that out of mom and dad's advisory account, their wealth management account.
That's what people would think.
That's what they think. What's the answer?
But the answer is neither one.
How can that be?
Because this is a non-recourse loan.
Non-recourse.
Which
can you define what that means?
Which means that whoever's left behind is not responsible for the debt. And what's interesting about this piece is that they cannot touch any of the assets. So who writes the check to the bank?
Sounds like the bank is on the hook to the bank.
No.
The federal government.
FHA writes the check to the bank for the difference. That is why the closing costs are so much higher, because that 2% was an insurance policy for peace of mind for the parents, that if they do this strategy, it's peace of mind knowing they're not passing debt to their children. Is this important to them? Absolutely. Which is the reason why the biggest thing it's creating out there is this fear. They think that the kids they're on the hook, they lose all this, but that's why the closing costs are more. That 2% is a trade. Now here's what's great about this. When I show the math and people literally live in their house, the key on this whole program is that arbitrage to where you don't want to do this loan and get out of it in less than a year. If you do, now you really are paying a very expensive loan because you're physically paying those costs.
You're paying those closing costs back.
Yeah, literally. So the longer you stay, the property appreciates in value. The longer you stay in the house, the better. The property value is going to offset all these costs and a chunk of this interest.
So George, let me take you back to 2008. Mm-hmm. So you've been in the business for 20 years. You were in, 4 years prior to 2008, it sounds like. So somewhere around 2004, housing prices just were going through the roof. Then 2008 hits, mortgage housing crisis. The reverse mortgage out there, folks did have that upside down factor playing into their loan. So if that happened again, if you can go back and maybe tell me some stories about folks who had homes worth less than what they owed on them because of what they had taken from their reverse mortgage. Tell me how that's played out for those folks.
First of all, the question we need to ask is how many people have been foreclosed on that had a reverse mortgage?
Yeah, how many people have been foreclosed on that had a reverse mortgage, George?
Zero.
Zero.
Why? Because there's no payments on this program. The difference with a reverse mortgage is you get to ride out the market. You get to see the ebbs and flows of a market, right? This program is a non-correlated asset. There's only two ways to capture housing wealth today in the marketplace. One is to sell your property, and then you got to figure out where to live next. The other place is incorporating this line of credit. If they put this line of credit into play, this growth is guaranteed. So if the market goes south on the value of the home, but I tell clients all the time, do you want to sell in a down market? No, probably want to ride it out, right? So what we want to do is there are no payments, so there's no pressure on the cash flow position. We kind of ride out the market and let it recover. When it recovers is the time to physically sell the property.
Non-correlated
Right.
asset. I picked up on that earlier. Word that you use. Can you talk about non-correlated assets? You know, the reverse. I talk about that with my clients
Oh,
a lot.
yeah. So what we're doing is in today's market, in today's value, all we're trying to do is when we do an appraisal, it's just to determine what parameters or what do we set this line of credit at as of today's market value. But once it's in place, okay, as this growth feature on this line of credit continues to grow, if the values of the home, physically the market value, the appraised value goes below, can the line of credit exceed the value if it goes the other way? And the answer is yes. Can they pull the money out at that point? Yes. You can. This is a guaranteed non-recourse loan.
Wow.
So if the line of credit is 400 grand and your house is only worth 200, now how often does that happen? Well, there are some people back in the old days that didn't pull out the money that physically have pulled out the money where the values of the home were lower. It didn't happen too often, but there were some cases that that happened. But they can pull it out. That was part of the benefit of this program.
And so, again, they're using the asset without disinheriting their children or leaving a debt to heirs.
Correct.
Is it important on a reverse mortgage that both homeowners, both spouses, be on the deed?
Well, first of all, if they're married, then there's a lot of different. That's a whole nother different subject because you can have the borrowers have to be 62 and older to be on the loan.
Okay.
But if a married couple, let's say we have a husband that's 75 and the wife is 45, you know, first of all, good for him, right? Actually good for her.
Right.
But what happens is, so the way what people used to do to take advantage of the system back in the old days. So this is one of the improvements. People used to remove the younger spouse from the loan so they can get the most money on the reverse mortgage to make it work, right?
Yep.
But the problem was they got removed from title.
Right.
So when that person died, guess what happened to the spouse? They were scrambling, trying to figure out what to do to get back in the house. So they changed that a while back. And they said, no, we're not doing that anymore. We're not letting you play this game of trying to get the most money. If you are married, we will take the percentage, though, on the younger of the two of you. And you're not on the loan, the 45-year-old, you're not on the loan. Only the person that's over 62 is on the loan, but they're both on title. And they have to be, because if something happens to him, she gets to stay in the house for the rest of her life. Right? So there's no physical mortgage payments in her lifetime as well.
While we're on title, how about those who have done estate planning where they have their home inside a revocable living trust? And can this work on irrevocable trusts or LLCs, partnerships, family LLCs? What's the rules?
Well, LLCs now, I do trusts all the time. Ladybird deeds, life remeasurement estates. Revocable is the most popular, and that's the most common. My goal is to follow the wishes of the trust, so we close a reverse mortgage in the trust. I work with Medicaid attorneys too. I do a lot of different planning tools.
Interesting.
And help people. And irrevocable to me is a very complicated one because you can't change anything. You got to do basically an amendment. That takes a little bit more. It's between attorney. We have an attorney that represents the banks that do the reverse, so they have to explain to the attorney what's the amendment to this trust, because you can't change it.
Correct.
What's the verbiage you have to add?
Yeah.
Is it more complicated? Yes. Revocable is easy. Revocable, you can do a lot of different changes, right? But we do close a lot in revocable trust too.
So there are some options, I think what I'm hearing you say,
Yes.
that if there's an irrevocable trust in place on a property, or even like a land trust, can it be done on a land trust?
Not land trusts. It's more like life remainderment estates, which is like a ladybird deed. If kids are on title, they still can stay on title, but they're going to be part of the process on the reverse mortgage, because the only reason why people do all these things is to avoid probate in their estate.
Correct.
So, but what we're trying to do is on the reverse mortgage, if they're on a ladybird deed or a life remainderment estate, those people have to be educated too with the reverse. So they're going to have to be part of the process, and they're going to be included in the counseling session for them to remain on title.
Got it.
But can you still do it? The answer is yes. But on that scenario, revocable trust, irrevocable trust, yes, complicated, but we still can get it done. But land trust, no, you can't do land trust. LLCs.
George, let me back you up a little bit. So on a revocable trust where I have husband and wife or the creators or settlers of the trust, then they are likely their own trustees of that revocable trust, the husband and wife. And then successor trustees might be children or trusted family members, or someone who they want to manage and control that trust after the settlers pass.
Yeah.
Do the successor trustees have to show up or be a part of the counseling, or just the primary trustees?
No, just the husband and the wife in that case.
Okay, all right.
But it's just more on the life remainderment estates, because there is no trust. It's just they're on title. Basically.
Got it.
And the title conveys 100% to them until the passing of the last person. Then it conveys 100%, and they just have to still do something with that loan, because the loan was tied to the clients that had the reverse mortgage, right?
So let's take a homeowner right now who has, I'll just throw some scenarios at. Let's say I have a 68 and a 66-year-old. They've got a home in, I'll pick Maryland. They got a home in Maryland worth $2 million, and they owe $400,000, and the $400,000's on a 15-year fixed mortgage at 2.75%, and they've got a mortgage on this property that's costing them about, almost $6,000 a month. But because they're prepaying, they're trying to get it paid off really quickly. But now, husband loses his job. Spouse is just making minimal income. What would you say to someone who has, and I'm just spitballing here with you, putting you on the hot seat, they've got a really low cost of money on their 15-year fix, but now they have a cash flow problem, and they've got this big requirement because they pushed the amortization from 30 down to 15, and they're like, well, Kenny, should I pay off my house? Should I take a distribution from my IRA and just go ahead and pay off the house? And you're going to be talking to this couple soon.
Oh, really? Okay.
Yes. This is a real life scenario. I should have told you that. Now, they've got this really nice asset. They're both in their upper 60s. Is it time for them to maybe consider a reverse mortgage? And I know there's a big onion here to peel back, but what do you say to folks who go, Kenny, I have a mortgage on my house. I got a really low cost of money. I don't want to. Actually,
that's a great one, because and a lot of people don't have an answer for that, but I do. I mean, this is my opinion on it. I'm doing the same thing myself in 8 months, because I'm turning 62, and I'll be doing the exact same thing that, like this particular, let's say these clients. So here's the logic. Here's the part you have to understand. The interest rates today in the industry are 7.5% currently.
Got it.
So I have a lot of people that'll come up to me and they go, George, why would in the world would I let go of a 2.75 and get a 7.5% on another mortgage? Why would I do that? I said, because there's two different factors here. Number one, if I give my money to the bank, that means I'm not making that $6,000 a month that I'm giving the bank. I'm not making anything more than 2.75% of return on my money.
Yeah.
But what happens if I free up that cash flow? Can I do better than 2.75%, first of all, on that $6,000 a month? Yeah, probably, right? That's what you do. That's where you're going to come into play, right?
Risk-free money.
Right. So my question, are you physically paying the 7.5 though on the reverse mortgage? And the answer is no. There are no on this program. So you're not physically paying 7. Is offsetting a lot of the interest that's growing on the loan.
So what I hear you saying then is that interest rates don't matter, cash flows matter.
Exactly. The goal in retirement is not to die with the most home equity. The goal in retirement is to figure out how to have more cash flow in retirement, right?
Yeah.
Here's the intangible. You brought up one intangible about losing a job. Here's a greater one. 2 people have Social Security income that's coming in the house. What happens if the traditional mortgage, the banks don't care if you get sick or somebody dies.
Right.
So what happens if somebody passes away? Well, their 2 incomes just went from 2 to 1.
2 to 1, yeah.
And now they have that $6,000 a month payment.
Yep.
And that person now is forced to figure out what to do next. Sell my house.
And their tax rates went up.
Tax rates went up. Their income went down. And now they're forced to do what? Do a forced sale of the asset of their portfolio. Right. It's forcing that scenario. And I'm like, this is the intangibles that people don't talk about. You're protecting each other. You're putting an insurance policy basically on each other to help in case something happens. The other person doesn't have to panic. They don't have to figure out what to do next.
Yeah.
Right. But I'm freeing up your cash flow so you can do more with it. So am I giving up a little bit of equity later to live more comfortable today in retirement? The answer is yes, but there's more benefits to this concept. It's just that we have to spend the time. Now, you did touch on another subject. So the HECM product is only, the percentages are calculated up to $1,149,825. So it doesn't matter if the house is 2 million or 1.5. The maximum percentage we get is based on that number.
Take me back. You used a term, and I just want to make sure we're educating our audience. You used an acronym. It sounds like HECM. Home equity
conversion mortgage.
Home equity conversion mortgage.
That's what it's called. This is called the HECM. It's another name for reverse mortgage.
Okay.
Right. Yeah.
And so there's a max loan to or max value of a property that's it's going to be calculated off of. So if my my clients here have a $2 million asset, primary home, the max calculation is going to be based off 1 million what?
$149,825. Now, we do have a proprietary product. It's a jumbo loan. Loans are designed for people in that 1.5, 2 million, 2.5, 4 million. I've done many of those over the years. But the trade-off is, first of all, it still has the same non-recourse feature, but it's not government insured.
Okay.
The proprietary. What's the trade-off? We base it on the full value, the percentage we're going to give. But the trade-off is the rates are higher.
Got it.
Because it's a proprietary product, right? So that's the trade-off. These are for people that have very high-end homes that want to get access to maybe some more of their equity of their property, or they don't care about that. Maybe they want just enough percentage to help pay off that existing mortgage. So like in your
is there a closing cost still of 5%, or is it 3% on a?
It's actually on high-end homes, the closing costs are way less. It's actually 2 to 3% on high-end homes. It's 5% is more on the average to below like
and
half a million.
Are you talking 100 basis points more or 1% more? I don't want to use terms that confuse the audience. So 7.25 going to 8.25, 10.25. What are you seeing that threshold?
Well, there are 2 different products. That's part of the education. When you and I get a chance to spend some time, I'm not going to go in great detail today, but you have a fixed rate product that are in the 9s. And you have a adjustable rate program that are in the 12s. So that's kind of what the rates are currently on the trade. But again, the trade-off is the values of the home at that bracket. Believe it or not, I still saw the spreadsheet. It still shows that there's tons of equity still down the road because of the values. It only has to do 1%, 2%. Remember, it's $2 million home. So the percentages don't have to go as high as maybe a smaller end property.
Let's say
And
this client, George, wants to in the future downsize and go to another property. Is the reverse mortgage purchase product still out there?
yeah, actually, I do the most probably in the United States on purchases because I teach a lot of tax strategies behind that product on the purchase side. So a lot of people are, I'm just as fluid as you are as a financial planner, right? I want to work right alongside. Strategies change. Today's strategy might be cash flow.
Yeah.
This happened. This is a true story. So I had a couple in Florida that did a reverse with me. And 3 years later, the spouse called me back and said, "Hey, George, I need another strategy." I said, "Well, what happened?" He says, "Well, John died. I don't want to stay here anymore. I want to live closer to my grandkids. And I just want the next strategy. What do you think?" I said, "Well, let's get your financial planner involved so we can work together on the strategy." But I showed her a way to physically pay off what she borrowed. Here's the key piece. This is what I do. I showed her how to take some of that housing wealth and put it back with that financial planner and help replenish that portfolio. And then the final piece is I show clients how to take the remaining housing wealth from the sale of their home and put it as their down payment to buy a house with a reverse mortgage. People didn't know you can buy a house with this concept. So I literally showed her how to buy more of a house with less cash, no mortgage payments, and helped her live right down the street from her daughter and her granddaughter.
Wow.
So she has less maintenance, no expenses as far as except for taxes and insurance. And to this day, she's happy because most people at this age bracket too also don't want to live with their kids. They prefer to have their own place, which is the reason why the strategy comes into play. Now, people that have a ton of qualified money, this is where I do a deeper dive with the financial planner and myself and the client to where I implement some of the strategies that I show on a discovery session.
And qualified money is traditional 401k, traditional IRA, SEPs, Simples, TSP, Thrift Savings Plan, any 457 government plans that were done on a pre-tax basis during your accumulation phase.
Correct. Yeah. And that's what I try to do is try to show some more strategies on that particular piece.
So what's the thoughts there? Just peel that back for us, a little bit of time that we have left today. So if you've got a big IRA and let's say you're approaching RMD phase, give me some thoughts, give us some education here today of how you would approach this.
Well, I mean, look, you're going to pay a tax no matter whether you do it today or down the road. The question is, are you going to pay it at a higher bracket down the road, or is it going to be lower?
Right.
And the tax codes are resetting in a couple of years, right?
That's correct.
So what happens is, can you pay it on the seed? Can you pay it on the harvest? Can you use a reverse mortgage to help pay for that conversion? So I work with David McKnight. He's wrote the book. Yeah, so I work with him and his
Power of Zero.
Power of Zero. So I worked with one of his advisors, and he came up to me and he said, "George, I got everything in a tax-free bucket. He's a $1.2 million house. It's free and clear." And he goes, "How do you use this line of credit?" I said, "Well, what are you trying to do?" He says, "Well, I want to convert this last IRA into a Roth IRA and get everything in tax-free buckets, right?" And I said, "Okay." I said, "So what else do they want to do?" They said, "Well, they want to get a second home in North Carolina." And I said, "Okay, super." So I said, "Here's how it works." I said, "How much is the tax liability to convert that whole amount into a Roth IRA?" And he goes, 35 grand. I said, "Well, so it's a very simple part." So what we did was the line of credit was about 300 grand. I said, "Here's what we're going to do. I want you to convert the whole amount into the Roth. We're not going to reduce it to pay the taxes. We're going to convert 100%. So what are we going to pay the tax liability with? Tax-free money, which is the reverse mortgage. So we took the 35 grand this is a true story, by the way. These are real life examples. So we took 35 grand from the line of credit and we paid the tax liability. And we converted that Roth or a traditional IRA into a Roth. Then I helped them take 20% down payment from the line of credit on the house in North Carolina. And with that 20% down, it eliminated the mortgage insurance premium that was added, right? The PMI, and the payment was lower. So I told them, I said, "Here's the best part. How much money did we have to pull out of the assets under management to do this?"
Yeah, zero.
We didn't have to do that. but it's just that people are just not familiar with all these strategies. And that's just one simple strategy that I've done on a conversion, because the IRAs today, the qualified money, it's not today, they're doing everything they can to go after our investments, unfortunately.
Yeah.
Under the Secure Act, right? You got people that are, can you pass it from one spouse to the other? No problem. Sure, that's the easy piece. But when that last person passes away and it gets passed on to the kids, those poor kids have to spend that money in a 10-year period where it
Right.
kicks them up in a different tax bracket where they're going to lose 30, 40,
Yeah.
50% of that IRA money.
Yep.
So this is unfortunately, a lot of people are not educated on that particular piece. And they're even talking about behind the scenes to change it from 10 years to 5 years. If
Yeah.
that does that, that'll destroy that IRA for those kids. And they have to, because it kicks them in a different income tax bracket. So when you do convert it to a Roth, it allows them to avoid RMDs. And is it easier to pass on to the kids?
Yeah.
Yeah. Yeah. So, but I follow the lead of the financial planner on what the game plan is, right? So I'm trying to see, and then I kind of use this as a tool to help clients understand and educate them first. And then we kind of implement all these strategies and we go ahead and start doing all these game plans.
So one of the things that I share with clients all the time I think sometimes I end up being a financial therapist of sorts, right? Within quotation marks. And the financial therapy, the financial behavior that people use sometimes to make financial decisions is littered with emotion. And it's the emotion of, well, my neighbor said reverse mortgages are bad. My other neighbor said that, or my prior financial advisor said that, insurance is bad. And we get all of this bad information. What I try to get consumers to do, George, and it sounds like you do the same thing here, is let's just sit down and if we can buffer the emotion just for a minute to understand the real logic, the math. Let's look at the math. And if the math shows that there's one improvement in scenario A over scenario B, logically, which one should we choose? And then we can go back and reverse engineer your emotion of the financial decision into your overall financial strategy. Human beings, whether it be a medical decision, a family decision, a financial decision, we all bring our own baggage and emotion to the table. And the one reason I wanted to do this podcast with you today was to try to peel back the onion a little bit and a little bit of the mystery on a reverse mortgage, so that folks can understand the alternatives that's really out there for them. And let's base it on logic and financial science. And then obviously, yes, you're going to come to the table with the emotion. Well, what happens if the markets go down? What happens if markets go up? And as you know, I promise you, markets will go down. And I promise you, markets will go up. What I can't promise you is when it's going to happen, or the timing and the sequence of that. And so reverse mortgages, for me, what I've seen it do for so many clients is control or have that volatility buffer that, David McKnight and his followers talk about, is the buffer control that you get in your investment accounts, the additional wealth that can be passed on to family members while not disinheriting yourself or your spouse from the liquidity, the use and control of, as you said an hour ago, debt equity in your property. And so I think we'll want to do this again in the future, Dave, where we can talk more about these products, and maybe we can go into some examples. One of the things we're building in KP's BlackBox is we're building a financial literacy program where folks can actually dive deeper into these, and there'll be some calculators and there'll be some tools that folks can use to put in their own numbers and do their own logic, do their own math before they show up to a meeting with you. So we want to have our clients educated and prepared so that when they get to you, they can go, okay, let's dive right into the numbers and understand, how you guys can help us at Movement Mortgage. And so I really appreciate you today coming on board and giving us an education here. Is there any parting thoughts? Any reading material? Can they go to your website? What kind of resource do we have to share with folks today?
Yeah, you know what? So a couple things that I can do to help out. Um, Really, what I like to do is, if you look at my name up there, it's George Vrban. I don't know if they can see my name, VRBAN. Um, I'm also under localreverseguide.com.
We're going to have Jake pull that up real quick. Localreverseguy.com.
Localreverseguide.com.
I'm going to have Jake pull that up on the screen here for us.
I won't be able to because we're using the screen to see George.
All right, we'll let George share then from his end. George, can you bring it up on your end?
Yeah, sure.
And just share your screen. And that should work, right, Jake? Yeah, there we go.
Yeah, so right here, if you take a look, I mean, I have what is a reverse mortgage. And I have information on here. I'm literally licensed in 27 different states throughout the United States. And I have testimonials, obviously, through all here, too. And some of the myths and misconceptions. How does it really work? Get the facts. You know, here's some information just to start off with. I'm located in Florida. I'm in St. Augustine, Florida, but there's all my information here on this particular website. So localreverseguide.com is probably the easiest thing to do, is just kind of check there. What I like to do is, if it's possible too, Kenny, I mean, also just really reach out to Kenny. I mean, look, he gets it. He understands it. You know, reverse is only a tool. It's just another part of their tool in the tool belt. But having a financial planner that understands how to use this the correct way, to me, is key.
Yeah.
So, you know, implementing these strategies, I always recommend just always, you know, in this case, reach out to you too, Kenny. Just have them reach out to you, and then if they're interested, what we do is, you know, together between the two of us, we can do a discovery session. I do an education piece, and then I don't go into numbers until, you know, it makes sense to go into numbers at that point. We want to make sure people understand how this product works.
Yeah.
So,
FHA requires that a prospective buyer of reverse mortgage or user of a reverse mortgage, whether it be a line of credit or a traditional loan, they're required to go through a consulting or consultation. Can you share a little bit about that before we jump today?
Yeah, so it's an independent third party that's not endorsed by the government, but they're approved by the government to educate in a 40-minute phone call. Basically, it's all done over the phone. It's an independent verification of basically what I'm telling you is accurate. That's all they're trying to do is, and again, another safety feature that they've implemented to make sure people understand it. They're not going to teach strategies. They're just making sure you know the rules of the program, what's done with the money, or what's done with the loan after the fact. These are just the requirements of this particular program that you have to do over the phone. It's about a 40-minute session, roughly.
Awesome. Another question that comes up that I forgot to ask you earlier that we'll do real quick here is, mom and dad pass away. They die with a balance on their reverse mortgage. The children or the trust that inherits this property, what's the rules for the beneficiaries?
Well, first of all, within a 30-day period, they want them to notify the bank just to let them know what their intention is, what to do with the house. Like, for example, even though they send these letters that look like it's starting a foreclosure process, that's not the case, because they have to do that by law to, you know, because the last person passed away.
Yeah.
But if you contact them, let them know what your intention is. So if you want to keep the house and refinance it, you know, they'll give you a 3-month right off the bat to refinance, pay cash, figure out what to do to pay off the loan and keep the house. Sometimes I've seen 3-month extensions up to a 6-month period to figure out how to pay off the loan and keep the house. But in most cases, most kids today usually want to sell the property.
Yeah.
And the confusion is people think they get an automatic year, and that's not the case. They automatically can get 6 months to settle the estate, pay back what was borrowed, and whatever money's left the family keeps. It's no different than any other mortgage out there. Can you get 3-month extensions up to a year? The answer is yes. But you have to make efforts of reducing the sales price, trying to figure out what to do to move that house, you know, prior to the end of the year. That actually happened to my brother's mother-in-law. The house is dilapidated. Investors wanted to buy it. 5 sisters involved. Sold in the fourth quarter, but they all walked away with money still. So,
Wow.
but in that case, you can still get extensions up to a year if you have to.
Okay. How about if husband and wife has to go into a long-term care facility, meaning they have to leave the home? They still are alive. They still own the home, but they're in a long-term care or assisted living facility now and not occupying the home.
Well, actually, long-term care strategy planning is what I do probably the second most,
Okay.
with all the stuff that's going on out there today.
Yep.
I've seen my dad is one of them. He was in a nursing home for 6 months and came straight back home. He did it twice. So people can go into the nursing home. It's the last person that's in the house. So if that last person ends up going into a nursing home for more than 12 months, because you can go in there 6, 7 months and come back home, it's not an issue. But if it's more than 12 months, there's a good chance you're not coming out.
Right.
So when that happens, that 12-month period, that period of kicks in, they're going to ask the family to go ahead and start settling the estate because there's nobody occupying the house anymore. So they're going to, the house is collateral. They want somebody to do something with that property. So they're going to start asking somebody to physically figure out what they got to do to sell the house and pay back the loan. And
Wild ass question. How would the lender ever know?
Because they send an occupancy affidavit once a year again, and if nobody's responding to it, they'll come out there and check and see if somebody's physically in the house. And they
So
can tell.
if son or daughter responds on behalf of mom or dad, they have to answer that document truthfully, or that would be a lender issue. That would be a civil potential criminal issue to
Could be. Yeah, it could be. Just that's the
misinform.
reason why.
Yeah.
Yeah, I think the big thing that they should do is if they know that there's no way coming out, well, then they should start working on trying to figure out what to do to satisfy the loan and pay back the loan.
Got it.
Yeah.
George, you've been a wealth of information today. Is there anything that you want to share in closing today that maybe I missed or didn't? I wasn't educated enough to
Yeah, for me,
test.
my bit of advice for a lot of people after I get done educating is that, people unfortunately get advice from people that are more messed up than they are. And it's unfortunate, but if you do your due diligence and fear is nothing more than the absence of knowledge.
Correct.
If people don't get educated on this stuff, they're going to hear stories. And again, I'm not going to heart surgeon to figure out how to fix my knee.
Yeah.
You want to go to the experts, right? So the financial planners have done the research, they've done the due diligence. Obviously, I'm an expert in this field. I can literally, provide you all the documentation, whatever you need. Everything. This is a government insured loan, so they have all this stuff and these protections in place. It's not a proprietary type product in this particular case, So, yeah. With that being said, just be open-minded, understand, and just get educated. Then you can make an informed decision based on all the facts and all the information you have in front of you. And then if it's for you, great. If it's not, it's okay too. At least you got the information correctly.
Awesome. Love it. Hey, I always ask, what are you reading? What are you into out there besides reverse mortgages today? Anything you'd tell people? Pick up a book and read, and it doesn't have to be about reverse mortgages. What?
Well, I read the Bible every morning.
That's awesome.
But
it's a great place to start.
Yeah. But I'm very thankful of the blessings I've been bestowed in my life. But my big spare time, I play soccer. So I'm still playing. And
really, and you played college soccer, college football.
Football.
What position did you play?
Center forward.
Center forward. So that's a lot of running, right? I mean, doesn't the center forward run more than?
I'm kind of spoiled. I'm not in the middle of the field. I'm in the front, so I kind of run at the right times. And, I don't run out. I don't run as much as everybody else does, but I'm still happy. I'm still a big kid. I got to keep playing and stuff. As a matter of fact, by the way, I know, Kenny, you're looking for me to meet with some clients here. I'm actually leaving for Europe on the 13th, and I'm gone till the 27th. I'm actually going to Germany to watch football.
I don't know if Isaiah told you this when you were doing the pre-production talk with Isaiah, but we have friends who live in Paris, and during the World Cup, that was when Paris won, He was in
France?
he was in
France,
France for about 3 weeks during that time, and it was
Oh,
an
jeez.
amazing experience for him.
Yeah, that must have been crazy. Yeah.
I
Yeah,
s-
so we're going there. I'm going there on the 13th. I'm not sure, Kenny, if your client's able to be flexible and come on the 12th, or I can meet maybe on the 12th
they'll
sometime.
meet you in Europe. I'll have them do that.
Oh yeah, there you go.
I'll talk to Isaiah about that. We'll see what we can do. George,
Yeah, I also have part of my team, and I'll talk to you off the air on this
yeah,
one.
perfect. Hey, thank you so much today. Wealth of information. George Vrban rhymes with bourbon. Gotta love that. And thanks so much for jumping on the show with us today and being flexible with us on time here. So we really appreciate it, and we look forward to working with you in the near future.
Thank you so much. Look forward to it.
See you, man.
Speed 180.
Black box.